Fundication show, but our live version. My name is Kalani Michelle, and I'm one of the co-hosts of the Fundication show. And Christian, who is also a co-host, is not here with us today, but I do have a special guest. Our newly inducted, as of last month, in January 2023, our newly inducted CEO, Mr. Mike Anderson. Mike, thanks for taking time out of your busy day to join me here on live video to talk about pre-iShare.
Oh, thank you. It's kind of fun to be here.
Yeah.
Watched you guys do this many times. I've just never done it myself. It's kind of interesting.
Yeah. Now you get to join the party.
Yeah, absolutely.
Yeah. So all those times when you wonder if we're working or not because we're just playing around on camera, now you know what we're doing.
Yeah.
Okay. So Mike, we are this week launching our $100 million fund. I would love to dive into that today because it's something that our whole team has been working so hard on, and with your guidance, your efforts, your expertise, like we've really been able to finally bring this to market. So let's dive into it here in just a second. Before we do that, I would love for you to tell those viewers that are watching right now, why pre-iShare?
I've been in the syndication business for 42 years, and I like to think that I've learned a few things over those years. First thing I learned is that's a very good business to be in, and real estate's a fabulous business to be in. And when you can do it with other people's money and you're successful at it, they make money, you make money. I can't imagine a better way to go, and it certainly is a great way to build wealth. But along the way, some of my competitors and I have looked at the business, and there's a number of aspects about it that really kind of are difficult. Sometimes the sponsor and the investor's interests are not fully aligned. Sometimes when you're doing equity, there's not a reliable source to go. There's funding platforms, and but you end up doing your own raises regardless. And what we've found over the years is that can be pretty nerve-wracking. You're in your 11th hour, you've got $500,000 of earnest money gone hard. It's Monday morning, you got to close on Thursday, and you're $1 million short on your raise, and you're kind of new, and you don't have a real deep well of investors. That can be sort of disconcerting. And then you never want to give investors cash calls, and there's never a really great resource for that, to provide gap equity or preferred equity. And the worst of all is, for me, is that real estate still is generally considered, and it is, an illiquid market. So, if we have an investor, and sometimes lifestyle considerations turn into, somebody's sick in the family and we can't pay the doctor bills, insurance is not going to cover them and they need their money back. There needs to be a better answer for that. So those are some of the things. And then where do you go to get exposure? If you're a syndicator and you're doing a great job and you're truly doing investor-centric investing, where do you go to shout that out from the mountaintop? The mountaintop just didn't exist. So those are some of the reasons why we wanted pre-iShare. We thought we could fix those problems. So we just took our experience as sponsors and, hired a bright young group of people, including you, and said, let's go build this thing. So that's what we did it for.
And that's where we are. And we've come a long way. And just even the last year, 8 months since our brand has gone live. And so, we've come a long way.
Yeah, it seems like it's been a lot longer than that, just because, a lot of this is all new to the industry. So we didn't have a big book of, let's see how somebody else did it. We had to sort of invent it ourselves. And that's always a little more time consuming.
Oh, a lot more time consuming. Our approved sponsor program, our approved sponsor group, that process to build that out has been just one building block after another, along with, launching the fund and some of these other things that we're doing, building out the studio in Salt Lake City, Utah. And it's been, we've definitely had our hands full as a company.
Yeah. And in my whole career, I've never thought I'd be building a studio. That was just never in my thought process. So I'm glad that that part of it's done. I don't.
Yes.
I'm not really quite sure why you guys need such a great green room for that with a pool table and wet bar and all that stuff. But that's a discussion for another day, I guess.
Yeah. We'll have to figure out whose idea that was, Mike. Anyhow, okay, let's move on. So let's give a high level overview of what we do as a company, but also more specifically what we will be doing for our investors for the in the fund. So we
So a high level view would be the things that we identified as problems, we solved those, and we've got financial vehicles we can do. And that's how we'll be deploying our investors' cash, is solving those problems. And so we'll provide top off services to help complete transactions, raises for our investors. And then we'll immediately go back to our social media. One of the reasons we built the studio is to take advantage of the 40,000, I guess, about investors that we'd accumulated over the years and expose that to them. And if they're doing a 506c offering, we can just go ahead and they can bring their pitch deck and we can just put it right, demonstrate, what they're doing right in the studio. So that's a tremendous advantage to them. But what it does for us is it immediately backfills that our investment. So we get this sort of short cycle investment. When we talk about what we're doing for our investors, that'll become very clear why that's so important. Same thing with pref equity and also with being able to buy investor interests. And if we don't buy them, then the other thing we're doing is going to we're building out a market hub for where they can go ahead and list their property. If we don't buy it, then they can list it at a nominal fee and get that same broad exposure, 40,000. And what's interesting too is we haven't even launched any of this, and that number is growing. I was noticing that you guys are adding on about 50 or 60 investors. Like every week, I get on the call with you guys, and it's like another 50 or 60 people have joined.
Mhm.
So that's phenomenal. So that's just really kind of on a high level view of what we're doing. But when we talk about how the fund's going to work, you can see how that works into it. So
the exciting thing about our fund is no one has done it like we're doing it.
yeah, that is it. It is fun. It's exciting, and it is also nerve-wracking.
I was thinking about that yesterday. I'm like, this is a little terrifying, but let's just hire enough attorneys that we cover all our bases.
Yeah, I think our law firm, we've probably got half the attorneys employed. But and what's funny about that is that you're being innovative when your securities attorney that's been your securities attorney for 20 years goes, you want to do what? And one thing I remember years ago when I was a kid starting out and doing a little bit of development work, I did the first TIF bond in the United States, and which was a tax increment finance bond. And you just the city finances or the municipality finances it on the incremental tax increase. So I went into my lender and I said, yeah, we're getting a TIF bond. He goes, what's that? And I tried to explain it to him, and I said, it's an innovative financial product. And he goes, don't ever use that word innovative with a banker. We don't like that word. So that's part of what's been nerve-wracking about this is we are being innovators, but it's also the exciting part about it.
Something that has came up on the last show that Christian and I filmed with Capital Union Partners. We were talking about why there's difficulty with investors who want to be able to liquidate their shares, whether it's for health reasons, maybe they just need the cash for whatever reason, and how it hasn't existed unless they want to sell it back to the sponsor, or the sponsor agrees for them to sell it to one of the other investors. And so something that was brought up that we brought up was just that it hasn't been done because it just hasn't been done, not because it can't be done according to regulations and what our attorneys have informed us of. It just hasn't existed. And so here we are, we're filling in the gap there to be able to bring liquidity to an industry that is typically illiquid.
Yeah, and I always wondered why we did it that way. And talking to Brad, our securities guy, our securities attorney, I asked him why is it that those and everybody writes them the same way. I've been interviewing sponsors now for 2 months to take our approved sponsor roles, and no one seems to understand why we wrote it. And I kind of thought about it and talked to the guys about my business, my syndication business, and it was like because syndicators only have a certain amount of bandwidth. They get a deal closed, they're on to the next raise. So if somebody comes to them and says, I need my equity back, they've got to take equity away from that raise, to take that investor out. And so that limits their bandwidth, both in the attention they can give to new deals, and also it limits the amount of the use of that equity to a past deal rather than moving the company forward. So we just simply said, yeah, you can offer it to us. If we don't take it, you can offer it to the other group, somebody else in that investment group. And if that doesn't happen, you made a commitment for 5 to 7 years. And that's the number one reason people don't invest in real estate, because it's illiquid.
Mm-hmm. Yeah. Yeah, those are good points. Let's move on to just talking about the fund. Before we do, for those of you that are watching right now, we're streaming on multiple platforms and profiles and social media pages. And so would love to know if you're watching, whether you're watching the replay or you're watching the live right now, let us know where you're watching from. And if you're an investor, if you're a sponsor, if you play in the real estate industry, if you're interested in the real estate industry, or what enticed you to click on this video and watch it today. Would love to know all those questions. So anyhow, Mike, let's move on to the fund, unless you wanted to say anything else specifically that we're doing for investors.
No, I think you guys have covered this pretty well in other social media that you've put out. So if people are interested in that, sponsors or investors, they can certainly go look at that.
Okay. So let's move on to the fund. I was searching in my drive the other day and I found a video. It was a Zoom call of you, myself, I think it was Brad and me and some of the other partners. And we were talking about the fund. So we've been talking about this for at least having calls specifically related to the fund for 6-8 months now. It's been a while.
At least. Yeah, at least. Yeah.
I mean, that's been one of the ideas since the beginning. However, like when we actually started like sitting down and focusing, putting a little more time and effort into it, it was, I mean, I have Zoom calls from, 6-8 months ago, which is exciting that it's finally coming to fruition this week. So would love for you to tell the viewers right now a little bit more about our fund.
Okay. So I'll tell you, I was thinking about this as we're completing our pitch deck. I was thinking about how unique this fund is. Years ago, I wrote an econometric model that's now being taught in some universities. And it was really about how to exploit the inefficiencies of the real estate market. And and it was basically on market timing. And so if you look at, there's a couple of key principles to exploiting real estate markets and their inefficiencies. One of them is a timing issue. Nothing happens fast in real estate. If you look at the basics of supply demand, right? So if you want to add more supply because there's an excessive amount of demand, which has been in the housing market for years, look how long it's taken for us to add new housing supply. The entitlement process takes forever. It's getting worse. Then you got capital formation, equity and debt, and there's just a myriad of issues that by the time you get to meet current demand, the market might have shifted 180 degrees from where you thought it was going to be because it took you so long to get there. That's exploitable, and so pre-iShare, the business model, when we look to set out to solve some of these problems in the syndication business, we realized that first of all, by just providing liquidity, which is one of the biggest reasons the real estate market is not efficient, just providing some liquidity to those fractional ownerships in real estate, we solve a lot of the inefficiency problems. That makes our model exploitative in that we can take advantage of situations like we're in today in the market, where a lot of people we've had a downturn. People are a little bit nervous, want to get out. We can buy those at a discount, and it, uh, it solves cash flow problems for investors. And it's all, but most importantly, what it adds up to is short cycle investing. And you say, well, Mike, what's a big deal with short cycle investing? You say, well, first of all, it's unheard of in real estate. You see it all the time in the equities market, in the stock market. You have this, what they call frequency investing, where you continually move your money, capture your gains, and continually move your money. There used to be, when the market was really strong, there was guys that were called day traders, and that's all they did. Just every day they take their gains, close out their account, start the next morning, take their gains, start the next morning, and they're just constantly reinvesting those gains. A little bit tricky with the equities market. You kind of really have to know a lot about a lot of companies, or an awful lot about a few companies maybe, but I never was that. But we have sort of that equivalency now in pre-iShare, and that's maybe an illustration, Connie, that would help people understand. It's a time value money illustration. So let's say you wanted to borrow, or I was going to loan you $10, and I had two options. I could give you $10 today, and next month you give me 15 back, or you want that $10 for a year, and at the end of the year you'll give me $40 back. Now, intuitively, you say, "Oh, the $40 is a lot more than $5, that you give me next month. I'll take the $40." Well, what if you're missing in that whole analogy is, what if that $10 that I can loan to you today and get 15 next month, what if that was repeatable? If I had a lot of deal flow, which pre-iShare is set to do, if I have a lot of deal flow, can I reinvest that money next month, the $10, and make it $5 a month after that? So if I do that, and if I did that 12 times in a year, I would have had a gain of $60 because I made $5 every month, right?
Mm-hmm.
So that's the difference of high frequency investment. So, but then you say, oh, wait a minute. What if I took that same? So that's obviously a lot better. Never had that in real estate before, but pre-iShare is trying to take advantage of that. Then you say, but wait a minute. What if I take the $5 gain that I had, and if the market was for $10 investments, could I reinvest that? And if it was $10, then that means every other month I could make another $10 investment. So that means I make 6 more $10 investments in that same time frame. So that's how you start building in the compounding of that. And so you say, well, what's that worth? Well, it's worth another $30, right? Half of the 60 I made on the initial $10 investment. So all of a sudden, now you've got $90 a gain. So then $40 doesn't look so good. That's the difference. People buy real estate and they hold it for that year, and they get a $40 gain and say, that's great. Yeah, and it is great. But pre-iShare is saying, if we can build the deal flow and hold that on short cycle investments, which we're designed to do, then our gains could be multiples of that. So that's how we're deploying that capital. So, that's the basic business model. It's a little financial engineering. There's other complications to it. Like, not only are we not doing $10, these are leveraged transactions. So we're working on somebody else's money at a lower cost. And there's a lot of other elements that go into it, which increase risk. And so there's risk mitigation. And that's maybe the most important thing we can do for our investors is first mitigate risk, second improve their returns. But we got both of those built into this investment. And both have very, very, very strong positioning, both to mitigate risk and to maximize returns.
Yeah. And this is why, Mike, we needed you as our CEO. I'm going to stick to operations and marketing. We're just going to pull every bit of information out of that brain of yours that we can.
Well, see, and that's what makes you so important. The whole marketing team makes it so important. Why? A couple of reasons. One, sponsors need, one of the things they desperately need is exposure.
Mhm.
And you're providing that exposure. You're building them. You're one of the top brand authorities in the country. You're building their brand and you're building their exposure to the equity markets.
Mhm.
That's huge to them. Plus these other financial vehicles, which is our way of deploying that proverbial $10 a month.
Mhm.
That those two things combined gives us deal flow. And the whole thing that we need desperately at pre-iShare to make that business model work is deal flow,
Mhm.
and the ability to pull that cash back on a short-term basis. So we are spending monumentally more money on social media programs and
Mhm.
exposure to that process because right in the pitch deck, and I don't know who wrote it in there, it says market presence equals deal flow.
That was Christian.
And that was just that statement is right on. That equation is exactly right. So maybe um, I would say that the market presence has just as much importance to us as the deals, real estate deals we pick to invest in.
Mhm. Well, and that's why since day one, we've been putting a lot of time and effort and resources into the marketing side of things. And luckily, well, not luckily, we have a great team. We've built a great team. Nick, Brennan, Christian helps there, and some other individuals. And it's just been great. And the great thing is, the more exposure that we build for ourselves, the more we will also be able to build for both the sponsor and for investors. And specifically for the sponsors, when they're part of our approved sponsor group, which if you're watching this now and you want any information on our approved sponsor group, you can email sponsors@preishare.com. But the more we build up our marketing and exposure, the more we build up theirs, because we'll be listing them on our website. Actually, we'll be listing them on Listing Hub, and then also on our main website. We'll be promoting them on social media. We'll be having them on the Fundication show. I mean, there's so many different avenues that just by them partnering with us and being part of our approved sponsor group, they'll get there's a lot of benefits that come with it. And again, we don't know anyone else in the industry that has an approved sponsor program and that's doing things that we're doing and that is on the side of the sponsor too. You know, we're here and we're bridging the gap between sponsors and investors. And that's the beauty of what we do. We're not just one-sided. We're not all for sponsors. We're not all for investors. We're really trying to create more transparency and a level playing field, as you came up with in the beginning, Mike, between sponsors and investors.
Yeah, exactly. And I think the better care we take of our sponsors and making them successful and solving problems for their investors, helping them make informed decisions, um, invest with a greater deal of confidence, and invest with, most importantly, the ability to have liquidity of their
Mhm.
investment. That they're not signing up and saying, "Yeah, keep my money for the next 5 to 7 years." You know, uh, then we'll have loyalty to us, and with all of what we're doing in the media programs, we'll be able to disseminate that information effectively. Then we'll have the deal flow we need
Mhm.
for the fund,
Mhm.
and the rest will take care of itself.
Yeah. So with the deal flow, just to add on to that, so we're building out our listing hub. Hopefully, we'll be done with it soon. I was just working on it yesterday with the developers and stuff. And the great thing about the listing hub is we're not acting as a broker dealer, though. Investors will be able to list their fractional shares on the listing hub. And then with approval from their sponsors, they'll be able to sell their fractional shares to other investors. Did you want to say anything else about the listing hub, Mike, that I might have missed right there?
Well, other than that, just think about how tremendous of a resource that is, both for investors.
Mhm.
They'll be able to go to one place shopping to do the same thing that we're doing with our fund, and that's diversifying their portfolio, because it'll be diverse by geographical location, by sponsor, and by asset class. So, and I suspect there's going to be a lot of opportunity in there. Uh, they can buy it at a discount. So I just think that I've talked to a lot of people that are investors that say, not only do I want to sell a couple of my assets on there, but I would be a customer for that,
Mhm.
and so because I would want to buy off of that. because I've never really thought about diversity. You have a tendency when you invest. I've dealt with this sponsor. He only does multifamily, or she. I've talked to several women that are doing this now, which is interesting. But I invest with a certain sponsor, and I'm comfortable with them. But I wake up one day, and all of a sudden, all my portfolio in real estate is multifamily, and it's maybe even in one geographical location,
and only value add.
And only value add, yeah. And that just seems to be the trend today. And all of a sudden you wake up and that's all you have in your portfolio, and you think, boy, I hope nothing goes bad in that geographical location, and I hope value add still remains. They can still get the capital necessary. If not, they can come to us and we'll give them to private equity if needs be. But sometimes right now with the capital market so tight, it's sometimes hard to borrow some of your CapEx money. Lenders are getting a little more stingy.
Yeah, that's part of why we're doing what we're doing, Mike.
Yeah, absolutely.
Yeah. Well, and again, if anyone's watching this right now and you want information on our fund, or you want to see our pitch deck, you can email info@preiShare.com. Mike, is there anything else you wanted to say about the fund or what we're doing that the viewers that are watching this right now might find interesting?
I've committed $1 million to it. I'll tell you one thing that's interesting, just a final thought for me. I committed $1 million to it, and then when I started looking at it, not really understanding necessarily what I was saying all along, because I wished I could invest more right now. I realized that the way that you have this equity growth inside that fund itself, you only end up probably, and I'm not sure, but it looks like to me like you'd only make about $250,000 investment and would grow to that $1 million commitment in 5 years. So if they're not deploying faster than that, you would cover your total $1 million commitment with $250,000 or less. Also, and that makes it reachable for everybody.
Yeah.
So, well, not everybody, but accredited investor certainly could reach to that.
Yeah. Well, and there's around at least 13 million accredited investors here in the U.S. So if some of our lists are only 40-something thousand, we still have a lot of ground to cover, Mike.
We do. I got a feeling that fund should fill pretty fast. My feeling is that it will. The first thing is you got to understand the financial engineering that went into it. And once you get that concept in your mind, then I think it becomes really a no-brainer. The question is just, can you afford to make that financial commitment right now?
Well, and if 100 investors at $1 million, there's a $100 million fund.
Yeah, we've already got a number of investors who want to take bigger chunks than that, but we're limiting, how much they can take, because you get too many people in there. There's even over 20%, they have a tendency to want to row the boat, and they might not understand real estate the same way we do.
Yeah. So that's why we have you at the helm, Mike. So appreciate your time. Thanks for coming on.
There's a lot of talented people at preiShare. So
there are. We have a great team.
Yeah,
so
we do.
Yeah. Anyhow, again, thanks again for joining both Mike and myself today on another episode of the Fundication Show live. And again, if you have any questions about the fund, you're interested in seeing the pitch deck, or you're just interested in reaching out, feel free to email us at info@preiShare.com, and we'll see you again probably next week. Have a good day.
Thanks, Bonnie.
Thanks, Mike.